Hey, what is going on, YouTubers? This is a video that I've wanted to make for a pretty long time. Upstart Holdings, ticker symbol UPST. Now, this stock received somewhat of a bad reputation as being a bit of a hype stock, not nearly to the same extent as Palantir or a Zoom or a GameStop, but definitely trended in that direction. As with many other stocks in the tech sector, this stock was on an unabated downtrend from the early to mid 2021s till now, with earnings being the sole saving grace. This thing, popped 35% on earnings before fading a bit on the Russia-Ukraine news and perhaps just naturally giving back some of its gains. In this video, we're going to be covering three different things. First is, we're going to go into the earnings release, go into the conference call transcript, and figure out how good was the earnings exactly and why the stock rocketed up. Second, we're going to talk about whether this company can survive in this relentless rate increase environment and a return to normalcy in terms of credit quality and fading stimulus. Third, we're also going to get into valuation, the technical analysis, and where I see the shares going from here. If you're new to my channel, welcome. I go by 10 Bagger. I've made over $1 million in the equity markets through nothing more than plain old buy and hold investing. I also do this professionally, and I thought I would use what I know to hopefully help you guys beat the markets. And surprise, starting with this video, I'm actually going to be ditching the sunnies because I thought you guys deserved more engagement. It's not that the privacy concerns aren't going away, but I'm confident enough in my research process and the results that I want to optimize for spreading my message to more people. So if you're one of my early subscribers, thank you so much for sticking with me. I promise it's only going to get better from here. You know, what bothers me is that there's so many YouTubers, they only focus on growth. They only focus on these sexy names, and then they see a guy like me. Throughout a lot of 2021, I was heavily invested in many cyclical companies. You might think that's boring, but stuff like banks, airlines, real estate, if you go back into my channel. But therefore, I've been able to avoid a lot of the carnage that has been happening in the growth land. And now with the ARK complex forming almost a perfect bell curve back to the lows, I do think that the selling seems a little bit overdone, especially if you look at some of the multiples that some of the highest quality growth companies are trading at. And I'm going back to a lot of those names to ride out this next wave. All right, let's start with a 30-second refresher on what Upstart is. Upstart is an AI-powered lending platform that provides an alternative to the 30-year outdated FICO system. By leveraging tens of billions of data points into its AI-driven model, Upstart can help partner banks deliver tons of new applicants to banks that their models otherwise would have outright rejected as being quote-unquote too risky. See, only about 48% of Americans actually have access to a prime rate of credit, but 4 in 5 Americans have never defaulted on a loan. So how can that be? I think that speaks to the opportunity that these guys see, and that 32% that you see here, this delta represents an arbitrage opportunity or the white space by which a player like Upstart can operate. And if we look at their earnings, this company is absolutely trending in the right direction. Revenue in the fourth quarter hit $305 million, considerably higher than the 250-ish expected by analysts. It is up 252% year over year. They're also improving on the profitability front, with about half of that showing up directly in the gross profit and close to a 20% net income margin. That is crazy. That is what like a lot of banks would dream of, like brick and mortar banks. And a 30% EBITDA margin. Wow. These are some seriously impressive results. I think the most important aspect of these results is that everybody can have a blowout quarter, right? But the important thing is that the company seems to have hit an inflection point. We saw a massive 20+% move in the share price to the downside when the company reported its Q3 earnings, and it continued to bleed from there. And it's not hard to see why. While growth was still up, the delta between Q2 to Q3 results was only 36 million, whereas the delta going from Q1 to Q2 was almost 2 times that. And what's also pretty bad, especially in this environment, was that gross profit took a hit. As you increased that 36 million in revenue, none of that went to the gross profit line. So what happened was analysts and investors like myself were left wondering. Before, this was a company that was growing almost parabolically, and now with this quarterly report, growth looks like it's slowed in a pretty dramatic way. What if in future quarters they're showing even more signs of weakness? Well, it looks like those concerns were pretty damn overblown. Look at these results. Quarterly revenue is up nearly 80 million on a sequential basis, up from 36. And look at that gross profit. Gross profit improved by 53 million. What this means is the hockey stick trend is intact, And it couldn't have come at a better time. It's coming at a time when the stock is trading at a 70% discount to its all-time highs just 3 months ago. All right, I'm gonna call it now. Out of all the companies that have reported this year, this is by far the most perfect set of earnings that I've seen this season, and I don't think any other company is gonna top it. Revenue beat consensus by 50 million plus, profitability is way ahead. This isn't a company like a firm, right, where they're bleeding on margin and they're investing heavily in sales and marketing. This is no Twilio. They're not growing the top line at all costs, sacrificing margin in the process, and that is the most impressive thing. And what's really impressive is that this all happened at a time when the American consumer and sentiment was actually deteriorating by a lot and not strengthening. I mean, you know, based on my fintech coverage, that a lot of these names that are exposed to the American consumer are getting hit and they're guiding on weakness. So yeah, guys, a 35% increase the day after these guys reported earnings. Is that crazy? Yes. But should the company have fallen this much after reporting earnings that were this good? I think that move was absolutely justified, and this company could still have room to the upside. However, you have to remember that only a small part of the stock's movement is actually attributed to past results, but we have to ask ourselves, where will this company be in the future? What about the prospect of rising rates, higher inflation, a less confident consumer? Are we predicting a slowdown or at least a tempering of expectations? So while we're at it, let's talk about what this means for the elephant in the room, which is whether fading stimulus and rising rates will hurt Upstart's business. First, we have the empirical results. The company has already reported earnings for the first half of the quarter, so they have some pretty good visibility when they give guidance for the first quarter, how the second half and the whole quarter will shake out. Now, keep in mind that late Q4 and early Q1, the real rate has already increased considerably. The rate on a 30-year mortgage has increased from about 3% to 4%. And credit costs are tightening across much of America. Anyone who's tried to apply for a loan on a mortgage or an auto in the past 1 to 2 months, you know exactly what I'm talking about. At the same time, inflation has also and is in the process of diminishing the purchasing power and the overall confidence of the American consumer. We saw this in multiple University of Michigan sentiment studies in the past 2 months or so. So despite all this happening in the background, in the first half of the quarter, Upstart is not seeing any evidence of a slowdown. In fact, they're guiding $305 million of revenue for this quarter. That's actually a really good thing. This company only guided about 250-ish for the fourth quarter. And the fact that they're able to guide, and they're usually conservative on the guidance, get back to the 305 for Q1, that's a fantastic sign. In fact, on the conference call, they had mentioned that access to credit remains something that transcends all credit cycles. And Upstart itself doesn't actually carry the credit risk like a firm. There's no cost of capital. They sell software to banks and are rewarded based on outcomes. The banks are the ones that actually have to ultimately decide whether to lend to a certain consumer, and as long as Upstart's AI performs and continues to feed them a pipeline of good customers that aren't going to default, that's okay for me. Because the thing about rates and banks, it's a double-edged sword, right? And not a lot of people appreciate this. On the one hand, yes, banks make more money from customers when rates are higher because they're able to earn more on the customer deposits. But the flip side is they don't get as many customers that are looking to take out a loan, right? And one of the reasons that Citi has actually lagged behind its peers in the banking space is that they just aren't that good at generating new loan demand. It's not that Citi's broken. It's not that it's too big to manage or has a woman CEO. It's because their lending model is not working. So even as rates soar to all-time highs and the bank index notches all-time highs, if Citi can't generate new loans, their stock is going to remain depressed. And we see this with all banks. Even take Wells Fargo, for example. Going from Q3 to Q4, with that rate increase, we saw an increase in net interest margin, yes, but the flip side, it came from a cost of fewer applications. I want to spend a minute to talk about the market opportunity. If only 48% of Americans have access to prime grade credit, and we assume that there are about 200 million Americans between the ages of 18 through 65, that means potentially 104 million people could stand to benefit from Upstart services. Granted, about 20% of those would never qualify for credit in the first place, so maybe about 80 million. Upstart has only helped 1.8 million people so far. So that shows that there's a tremendous gap between where they are today and where they could be in the future. And I know not everyone's going to need a personal loan, but clearly the prime lenders today make a heck of a lot more than $1 billion and a $4 per year, which is what Upstart is guiding for 2022. So this is where Upstart comes in. Upstart is helping these banks find new customers. And it's not like they're overcharging for their services in an egregious or unsustainable way. If we add up all of Upstart's revenue going from 2014 since inception to 2019, 2020, 2021, we get to about $1.4 billion. I don't actually know how much they made in the 2014 to 2016 period because it wasn't public. But if we look at the fact that they made about 57 million in 2017 and has been an upward trajectory, I think we can conservatively assume that they probably made about 50 million in those first 3 years. So based on having helped 1.8 million Americans, they're actually only making, if we divide that 1.45 billion by the 1.8 million Americans, they're only actually averaging about $800 from each person that they've served. And that's in a combination of fees charged to the banks as well as to the consumers themselves. That's actually not that egregious for a loan that could cost anywhere between $5,000 to $50,000. And that's just personal lending. What I love about this company is that they got a head start and they're getting into auto in a big way. Wells Fargo, which breaks out their lending between auto and personal loans, has it being 4 times the opportunity today. And rightfully so, perhaps, as Upstart's investor team sees a 7.5 times larger opportunity within auto than personal. And these dealers, they want to do business with Upstart, right? I mean, take a look at this stat sheet on how many dealers and partner banks they already have ready to go. But at the present time, given some of the supply chain challenges, they just don't have enough cars to sell. So when these supply chain issues improve, these captive customers will inevitably morph into real customers. And I think it's fantastic that the team has already rolled out a market-ready auto product way ahead of schedule, as this was something that they were going to do by the end of 2022 versus already having it 10 months ahead. So let me sum it up. When the stock is down this much, they're actually producing earnings and accelerating in the right direction, and their stock price took a massive hit, and they're getting into a 7x market. I'm willing to take a chance on their thesis and the conviction that, yeah, maybe higher rates won't negatively impact their business as much as we thought, and even if they did, you would think that with a 70% haircut, that's more than priced in. Now let's talk about the $400 million buyback. I mean, that's pretty much all the excess cash that they have between cash and debt, so it's actually a pretty ballsy move. And some analysts have questioned whether that move in year 2 as a public company is really the right call. And yes, it is highly unusual for that to be the case. But it's not because they're running out of things to do. They're still hiring in critical areas of machine learning, engineering, marketing, growing out their auto business. But the CFO here is pounding the table with absolute conviction that the stock is greatly undervalued, that they think that the best use of their capital right now is actually to buy the stock down here. And it's actually a pretty great move. I hate it when companies do buybacks when the stock is all the way up here. Like when Facebook was doing buybacks between 320 and 370, they're kind of just squandering all that cash. But when you're down in the dumps, like Wells Fargo was back when they were $30, $25 per share, and they announced that $18 billion buyback, or with Upstart now, that's actually a really great sign. Not only because mathematically at a $10 to $11 billion valuation, buying back 400 million of shares results in about a 4% accretion over time in their share price. It also sends a very clear signal to the shorts, and this is one of the most shorted stocks in the market, that this money is going against them. And the company knows that its shares are undervalued. But since you're watching my channel, we have to take a balanced perspective and talk about the negatives. And out of this report, I only saw 2 negatives and 1 big looming overarching negative that I'll discuss later. The first is that Upstart actually reported a meaningful uptick in fraud rates during the second quarter of 2021. And this data is reported with a delay, so we don't actually know what Q3 and Q4 are going to look like. But based on the economy, we would expect there to be some sort of deterioration. However, on the conference call, they mentioned that on Q3, the team was looking at fraudulent applications on the platform, but there's no longer any mention of that in Q4. My guess is that they temporarily contained how much they're willing to lend, thus artificially suppressing some of those Q3 results as they were dealing with their issue. But now their AI model has been properly trained on how to deal with these fraudulent cases. And based on the tone of the conference call, my guess is that the worst here is behind them. The second is profitability. Now, analysts, especially this quarter, love to talk about profitability, especially in a rising rate environment. And profitability is going to be a little bit down from where they were in Q4 for a number of reasons. The first is that Q4 beat their expectations. they had budgeted this much for sales and marketing and go-to-market initiatives, and they ended up getting this much in revenue. So that delta represented artificially higher margins that they sort of lucked out to benefit from, which is actually a good thing. This sort of dynamic only happens when there's compelling product market fit, and you have a lot of companies that are actually trying to do the opposite. They're spending way more on sales and marketing and getting less, but these guys are actually benefiting more. The second reason, and the more predictable one, is that the company is ramping up its investment in the auto business. Every business has a scaling element where they have to get to the other side of the J curve, and auto is no different. The fact that they have 10 months of runway ahead of schedule and is able to invest in the offering today and get to market sooner is a great development, if you ask me. So when management guided lower margins in Q1 and Q2 of this year, that's actually a really good self-inflicted kind of harm to be in a stronger position for tomorrow. Considering what they're choosing to spend that money towards, considering the size of the auto opportunity and their execution in the personal loan space, and the fact that take rates can be the same level as personal loans, I will be a buyer here on any margin-related weakness if it shows up in the stock price. Now let's talk about the main overarching downside, and that is obviously the customer concentration risk. See, when Upstart had just 12 partners at the end of 2020, one customer, Cross River Bank, accounted for 63% of the revenue, and they had a very strong second customer as well. If you fast forward to today, the company has 3.5 times more revenue. That number is going to be significantly less as the company is naturally able to scale its relationships to more than 50 partner banks and institutions, and that is evidence of a much healthier relationship. I don't know what the exact concentration number is, but I know it is significantly less and will only continue to decrease over time. All right, so with all that said, I'm going to summarize and give my recommendation. Can we just go back to the metrics for a second? 252% revenue growth in 2020, guiding 65% plus growth at the conservative case in 2022. 50% gross profit, maybe 40%, but 40 to 50%, 20 to 30% EBITDA margins, and close to 20% net income margins. Considerable operating leverage as we saw in 2021. Assuming that they earn at least $5 per share in 2022, which is very doable. They earned over 80 cents in Q4 of this past year. I mean, does this sound like a company that should trade at a PE ratio of 25 times? I've seen wildly unprofitable tech companies still trade at 25 times revenue, yet these guys are very, very profitable. From a technical perspective, we're seeing a lot of support at this 120 zone, but also a fair amount of resistance at around 170. We're probably not going to see lower than 120 anytime soon, since the stock broke 120, 130, 140 to the upside with absolute conviction on that earnings report, but there is some resistance at the 140 level as well. It would take another break above 170 to really send shares soaring. So if you're looking to get into the stock, I think your downside is probably limited to around that 120 area, but your upside is probably also limited to about 170. So it's in this 120 to 170 range. But if you break 170, I mean, look out above, because this stock from a technical perspective, it's absolutely going to be off to the races. The last time we broke 170, it went all the way up to 400, and then the rest is history. So with a lot of macro uncertainty out there, I actually think that the best course of action is to probably wait until the outcome of the Fed meeting, because there's going to be a lot of uncertainty about the Russia situation. I'd personally wait until after that, because if the Fed somehow really surprises to the downside, or you have an escalating situation in Russia, then you don't have the generally positive tailwind of earnings, which happened now in early March, to then help your situation. But make no mistake, I am absolutely an overall buyer of weakness here. All right, guys, that's going to be all for this video. Thanks so much for watching. If you found this helpful, please consider helping the algorithm out so I can spread the word to more viewers like you, and I hope to catch you on the next one. Peace out.